right. So we talked about a lot of things yesterday, but we'll start with introduction to financial statements. So it's going to be as like yesterday, very interactive. So can somebody just tell us what he or she learned about financial statement yesterday? Adia Khadijat. Can somebody just tell us about what they learned yesterday with respect to financial statements? Akman, should I come? Should I? No. Why? My guy, you now from BOI now. Eh? Well, anyways, Madam Philo, you want to tell me something? Financial statement. We talked extensively yesterday about financial statement. Okay, just tell me what is one thing that you learned yesterday. Let's start from there. Just tell me one thing you learned yesterday.
I learned about company liability, assets, capital. Assets were separated into two places, right?
Yeah, go on, keep
The
going.
fixed assets, like the building, the machines, the the building, the machine, those are fixed, and the land.
Yes.
And we learned about the current assets. Those one has to do with the materials. I think so.
Yeah,
The material.
inventory. Thank you very much.
So,
Thank you very much for that. Can somebody take it up from where she stopped? Huh? Okay. Thank you, sir.
Yesterday, about the financial statement, I learned that financial statement shows how viable a project can be in numbers and also shows the capacity to repay. And also, I learned some components of financial statements in terms of balance sheet, cash flow statement, income statement, and change in equity statement. Thank you.
Thank you very much. That is very good. But please still hold the mic. Now let's pick them one by one. You talked about balance sheet. Can you tell me what are those things you find in a balance sheet?
In summary, from what I learned yesterday, balance sheet just tell us what we own and what we owe in terms of assets and liabilities.
Thank you very much. Anybody else want to pick it up from there? These people have not resumed our class yet. When they resume, they will let us know. Ilya, do you want to tell me something about what you learned yesterday?
I think we learned a lot from the uh, financial statement that shows the analysis of the financial figures from all these operation. I will go to balance sheet, that tell record of the operation, record of uh, production, just depend on what that company is into, and also tell us, we learn about um, the asset as nominal assets, the current asset, the fixed assets, and how also to enter them to the table when you are trying to balance your balance sheet, and also try to things to be considered, maybe in terms of you are looking for financial assistance, and we get to understand that the people will have to look your inflow, have to check your your liquidity ratio, have to check to see your operation cost, compare, and your losses also. And we get also to know that if you have been recording losses maybe for a period of time, then you might not be in the right place to be able to get financial assistance. But if you are recording recording losses, but those losses are decreasing within some times. Show that the future might be bright. We might get people that will invest. And also, we also learn in all that to balance our balance sheet is good for us to get, to be able to give, I mean, keep our books intact for anybody that we are looking at. We'll look at system from. We'll be able to know that, yes, this is the state of our company or state of our business.
Thank you very much, Mr. Ilya. He went round. Sir, would you like to share with us some of the key points that you picked from yesterday's discussion?
Yes, in my own case, it's not just about certain key points that I picked, but a complete change in orientation.
Oh, fantastic. Tell us about it.
Initially, before I came for this training, I had a very myopic, as in when I say myopic, extremely myopic understanding of what a financial statement is. Initially, I used to think a financial statement is you just go to your bank, you print your statement of account,
And that is it.
and all those your transactions, and that's all. But yesterday, my understanding of a financial statement was really broadened. I really understood, oh, a financial statement has different components. Surprisingly, it's even about 4 components, not just all those your debit and credit
Credit in
that
the
you
bank
see
statement.
in your statement of account that you print from the bank. That you have the cash flow, you have a change in statement of equity,
Equity, yeah.
you have a which other one? Uh, income
Statement.
statements. There's the first one, cash book.
Balance.
No, sorry, balance sheet.
Yes, sir.
So I really had a broadened understanding of what a financial statement is, different from what I came here with.
Okay. Thank you very much for sharing that with us. We are really glad that. So, Mr. KC, I'm calling you KC. Whether you like, accept it like that. Ah, you've accepted it. Good morning, sir. For today. For all right. You came late. You pay your fine later. But it's understandable. Do you have anything you want to share with us based on what you learned yesterday? Just share your experience on a few things that you just picked, the key highlight for you yesterday.
Good morning, everyone.
Good morning, sir.
So, like I said, I've been coming up with following the training up. So they've been teaching us about the RECP and IEE. So I've been particular of the technical aspects and a little bit of the finance. Though that's not my field. I'm just into ensuring that products meet their best form.
Quality.
Okay, now, and set a quality management system. So when getting to this place, like I said, no man is an island.
Yeah.
So like I said, I came here to learn, unlearn, and relearn. So the reason why, what I got from this was how to move from the business planning to how to finance your plan. And all the documents you described for us, balance sheet, everything. So it gives me the broad knowledge of it. So when next time I'm dealing, though it's not my field, so when experts in those fields are talking to me, it won't look strange to me. And also I can impute one or two to see how we can achieve a common goal. So thank you for this.
Thank you very much. Any other person want to say something? Ajia Khadija in Akwana. Good morning. You want to share your experience with us? What's just one or two things that you learned? Nothing. Why? You don't want to share. Why? Okay. Sir, would you like to share one or two things that you just learned yesterday with us? You have a lot to share. Yes.
But now, coming here, I have the understanding, just as he said, no matter what they are bringing to me now, I can also interpret it.
You can interpret it. You have an
Yes,
understanding.
I have an understanding, and I still want to learn more today.
Okay.
God
Thank you
bless you.
very much for that contribution. Any other person wants to tell us a thing or two? I will not ask you, my senior colleague. So I will not ask you. Good morning, sir. How are you, sir? You were not here with us yesterday. Were you here? Yeah? You were not here. Your name, sir? Mr. Ethan. Okay. So what do you do, sir? Yes. So we discussed a lot of things yesterday. We talked about financial statements and how um, lenders, the likes of the BOI, can look at our books and determine if our business is good enough for them to invest, to give us a loan or not. Anyways, let's take it general now. So we talked about financial statements yesterday, and we mentioned that there are 4 elements of financial statements, right? Madam Philomena, can you mention one? The element of a financial statement. Hold on, Madam Philomena. Don't talk. Don't talk. Somebody said she didn't want to share her knowledge. Now she's speaking in the background. So share your knowledge with us. Element of financial statement. Now you mentioned 3, not 1.
Balance sheet,
Balance sheet, yes.
income statement,
Yes.
and is it change in equity?
Yes, statement of changes in equity.
Statement
Fantastic.
of state-
Hold the mic. Further question. What is an income statement? What do you have in an income statement?
Is it not the one that shows
Please speak up so that we can hear you.
what comes in?
What comes in,
Yes.
yes. And
And where it's going?
where it's going, where do you spend money on? So if you compare what is coming in and what's going out, what do you try to achieve at the end of the day?
To see if it's balanced.
Huh?
To see if it's if you're not spending more than what's coming in.
No, if you are making profits,
If you're making
that is what the income statement is. Mr. Ackman, can I come now? You want to tell me about balance sheet now? Yeah, you don't need pick, Abi. Okay, so tell me, cash flow statement. Just tell me what you got from cash flow statements yesterday.
Cash flow statement basically, I think it's just talking about how money that comes into an organization is distributed or utilized, used, basically, I think.
Thank you very much. How your money flows, what comes in, and how you categorize how it is being spent, how your cash moves in the organization. Can somebody tell me about statement of changes in equity? What is that about? Statement of changes in equity. Yeah? You want to tell me? Okay, please try, Mr. Ilya. Thank you.
Changes in equity from your balancing from your balance sheet. If there's a profit, that profit will lead to change in equity. If there's also lost, it's also lead to change of equity also.
Thank you very much. That is like the highlight. It's a very good explanation. Statement of changes in equity is just trying to show movement in our shareholders' equity, our retained earnings at the beginning of the year. Either we made profit or loss during the course of the year. We've paid dividend. What are we left with at the end of the year? So, can I say that we all now have a proper understanding of what a financial statement is, right? Financial statement comprises of 4 key elements. Our balance sheet, which shows us what the company owns and what the company owes. Under the balance sheet, we talked about fixed assets, current assets, and we also talked about other type of form of assets now. Intangible asset. Thank you very much. Can somebody tell me what an intangible asset is? An intangible asset. Tell me.
something you cannot see, but you can enjoy the service, the goodwill or the service.
Thank you. An intangible asset is the asset that you cannot see. Hello? Hello? Engineer Dejumo. Good morning, sir. How are you today? Thank you. So we talked about intangible assets, and Ajia Kajita said intangible assets are assets that you cannot see, but you enjoy them. Example, one is goodwill. And we gave an example of Aliko Dangote writing on a complimentary card for somebody to take to the MD of UBA. We also talked about the software that we use in our office. It is an asset. We cannot see the asset, but we are it to help our work become efficient and improve our turnaround time in our respective organizations. So that is asset. Then about liability. How many types of liabilities do we have? Just like we have for assets. We said we have fixed assets and current assets. Our liabilities too. We have liabilities under what? Long term and short term. So can you give me an example of a short term liability? Huh? Example of short term liabilities. Payables. Thank you, Ma. Ma? Salary payable. I don't like hearing salary payable under liability. Oh. I don't owe my employees. It's not appropriate. Ma? Short under short term, regardless, whatever the case, on or before the 30th of every month, pay. Just pay it and take it to the expense immediately. Other examples of current liabilities. Madam Philo, you want to help me? Short term now. Okay, tell me long term if you want to talk about long term liability. You want to tell me anyone? Bank loan, thank you very much. Which other one? Nothing. Okay, so that is for balance sheet. Then our income statement. What are the content of an income statement? What are the content of an income statement? Me meet for coming late. Good morning. What's your name? Engineer Victoria. Okay, you were not here with us yesterday. No, I don't accept verbal explanation. You'll have to send an email and you justify the reason why you decided not to come yesterday. Ma? You didn't receive. No, I'm saying to. You didn't. No, what I'm saying is you have to send us an email explaining why you didn't come yesterday, and you have to in that email that you are sending, you had an attachment to it, 45,000 naira as your fine. Yes. So yes, you add it to it. We say we don't want mouth apology. Just pay us the 45,000. Ma? Huge. How? It's not, oh, please. Yes, sir, you wanted to say something.
I want to say the uh, income statement shows the status of a company at a point concerning its profits and the losses.
Thank you very much. So, in that income statement, what is the first thing that we always talk about?
The profits and the losses.
Talk about revenue.
Okay, revenue
We
first.
talk about revenue, then we talk about types of expenses. What are the types of expenses that we have in our income statement? Can anybody tell me types of expenses we have in our income statement? Sir? Operating expenses. Yes, that's one. Then there's another one. Huh? Admin expenses, that will fall under operating expenses. I'm just trying to categorize, to differentiate between our direct costs. Yeah.
Other expenses.
We have, so under our income statement, we have our revenue, the money we have generated. Now, the next expenses, the first expense that we recognize is the cost of goods sold or cost of production. After our cost of production, we arrive at our gross profit, right? After gross profit, then you take out your operating expenses. And we said operating expenses are those costs you incur to ensure that the business runs smoothly on a daily basis. After taking care of our operating expenses, we talk about the interest on loan. We talk about taxes, we talk about depreciation, amortization, then we arrive at our net income. Thank you very much. So let's quickly talk about cash flow. Um, Akman has explained to us what cash flow is. And while we were talking yesterday, we talked about three different types of activities under our cash flow statement. Can we mention them, please? Madam Philo, you are shaking your head. I'll come back to you. Huh? Okay, let me go to my organs now. It's time for them to. Good morning, sirs.
Yeah, good morning, Oga. The three different activity under the cash flow is operating activity,
Yes.
investing, and
Yes. Finance
financing.
act. Thank you very much, sir. To maybe take it further and tell us the line items we have, examples of what under investing activities, financing.
Okay. In financing activity, the loans the company actually takes from the financier will actually reflect here. For example, the interest on those loans will reflect on that financing activity. When we talk of investing activity, you're looking at the investment you are doing. We gave an example yesterday. You could determine to expand your business by bringing in an additional equipment that will
Yes.
bring in efficiency. So in
Yes.
doing that, you spend money to bring in the equipment. So as you expend that fund, it's a negative to you because fund is going out of the business. So it comes under investing activity. But at the same time, if you, for example, sell maybe your obsolete items, cash is
Yes.
coming in. So
Disposal.
you report it as a positive activity under the investing activity, depending on the way the cash moves, because it's cash flow we are looking at here. Then under operating activity, this has to do with the activities that are directly related to the company's organization. So the same way, if cash goes out, it's negative. Cash comes in, it's positive. So that's how to do the calculation under cash flow statement. Thank you.
Thank you very much, sir. I think I'm really happy that we have a lot of people willing to share their knowledge from what was learned yesterday. So on that note, we say that, okay, yes, we have a good understanding of financial statements. So from there, we talked about financial ratios. Who can tell me what financial ratios are? Financial ratios. What does it mean? Financial ratios. We used ourselves as an example yesterday talking about we going to the hospital saying you want to go for a medical check. If you get to the hospital, the doctor won't just tell you to carry out malaria test and tell you go home. There are a lot of tests that the doctor will tell you to do. Same way for business operations, there are a lot of tests that we carry out to know if a business is performing well or not performing well. So, should I begin to call names? Who is going to tell me what financial ratios are?
Financial ratios are the numerical values that are used to get meaningful information about the status of a company.
Thank you very much. Do we all agree with that? Huh? You are all saying yes, but before you raised his hand, everybody was quiet. Anyways, thank you very much for that. So we talked about different types of ratios. Who will tell me one? Sorry. Yes, you, I'm coming. I'm coming. Give me one example of the ratios that we talked about yesterday. Just one. Open book, open book. Just, if you want to flip it, it's allowed. Just try. Just try and play it back slowly. Khadija, you want to play bail him out? Okay.
Liquidity ratio.
Liquidity ratio. Thank you. I'll come back again. We're not done. Good morning, sirs. You people came late. This table. Let me first of all remove the suite
Leverage.
first. Leverage ratio. Okay. Can I go with my suite because you people came late? It's fine. Don't mind.
Let me bail out, please. Let me.
Oh yeah. Okay, please. Profitability ratio. Okay. So we've talked about profitability, liquidity, so leverage ratio. Then there's one more. You want to efficiency ratio. Thank you very much. Now let's start from profitability ratio. What does profitability ratio? What does it measure? It is a test you do for a company. So what are you trying to do with that test? Afunki Show. Good morning once again, ma. Now, where's Mama T? She's not in today. Oh. Hey.
It measures the company's ability to generate profit, and we have gross profit, net profit, and one other one. Return on area. We have EBITDA margins. There's earnings before interest, tax, amortization, and depreciation.
Thank you very much. She has said it all. But now on that profitability, she mentioned gross profit margin, net profit margin, EBITDA margin. Sir, can you just tell us the formula or explain to us gross profit margin and net profit margin? Don't do over syllables. Thank you.
All right. For the gross profit margin, we try to relate our gross profit, which is gotten by taking out cost of goods sold from our revenue. So once we take out our cost of goods sold from our revenue, we get the gross profit. So we relate the gross profit to our revenue, which is what we call sales. And when we do that, we get our gross profit margin. And then the same thing applies to the net profit margin. It just, we go ahead and do the net profit margin too. We try to take out from our gross profit, we take out operating expenses to get our net profit. And when we get our net profit, we divide it by our sales revenue, and then we get our net profit. Then, that's all.
I say no over syllables, no collect extra sheets. Thank you very much. So do we all agree with what he explained under profitability ratio now? Are we together on that? So can we move to liquidity ratio? Mr. Valentine, around. Liquidity ratio. Adia Kajuja, you mentioned liquidity ratio. Can you now tell us about it and the ratios under liquidity, the types of ratios under liquidity ratio? Please go ahead, try.
Okay. Liquidity ratio should be how organizations can cover their costs and their short-term obligations.
Please say it again so that the class will
How
hear us.
organizations can cover their costs, like how they are managing their short-term
Short-term obligations. Thank you very much. So on that note, we mentioned two types of ratios under liquidity ratio. Yeah. Can you tell me one? No. Why? You do not remember. Okay, who is going to bail out? No, you're not you, sir. Who wants to bail out? Okay. Let me go to my guy at the top.
Good morning, everyone. Okay, so on that liquidity ratio, first and foremost, liquidity ratio will be looking at your ability to meet your short-term obligations. And under that, we talked about the current ratio and the asset test ratio. Okay, so for the current ratio is over current liabilities. Then for the asset test, it's your current assets, take out your inventory and divide it by your current liability. Thank you.
Thank you very much, sir. Okay. Maoga said, for us.
Okay, my question is this. In some books, you will see return on asset and return on capital employed under profitability ratio. While in some books, again, you will see them under efficiency ratio. Please, sir, where exactly are these two ratios? Return on asset and return on capital employed, where are they supposed to belong? Which of the ratios?
Sir, you want to help me out? Okay, I'm coming to you, sir.
When we use reward return, it's always under profitability. Return on assets, you are trying to see your net profit against your total assets. And no, efficiency again, you know, when you look at your total asset and you look at your turnover, that one will reflect under efficiency. It's not relating to profit now. You're looking at the total turnover of an organization. And I'm looking at it, for instance, if my turnover is 1 billion naira, and total assets that I use to generate that turnover, it's about 2 billion. Then you do asset turnover ratio. My turnover over my asset, 1 billion against 2 billion, so I have 0.5. In that case, people will say you are not being efficient because you are not adequately utilizing your assets. The rule of thumb for this is that you must have at least 1-to-1. That is the rule of thumb, but it does not apply in all cases, depending on the sector we are looking at. Some sectors have huge assets. If I operate in a service industry, I might just use my home, my house as the office. I don't have any building, I don't have much equipment, and I'll be generating much asset. So in that case, I'm generating much turnover. So my asset turnover ratio will be very high compared to a manufacturing company. But in essence, when you use reward return, it has to do with profitability. That's my understanding. Thank you.
Thank you very much, sir. You still want to add to it before I speak? Okay.
He has actually said something that is very useful. But in addition, I just want to add that the reason why we normally put return on asset and return on capital employed under both efficiency and profitability ratio is that efficiency ratio is actually looking at the performance of the management. If you look at it very well, efficiency ratio, the focus of efficiency ratio is to know how the management team, how they are performing. And that's why sometimes some people can put, some scholars, some textbooks, they put it under both. So, when you look at it, if you put return on asset under management, you easily use it to know how efficient those team of management they are doing there. So I think we have things like working capital turnover, we have inventory turnover, so many things under that. But the basic thing about efficiency turnover is we are interested in, we that we call ourselves the management team, how efficient are we? That's just the question that ratio is answering. Thank you.
Thank you very much, sir. Just to cap it, like my guy rightly said, anything return is you have put in money somewhere. Am I making profit on it or not? We have invested money in assets. What is the return that we are getting from that asset? So ideally, you put them under profitability. But yes, you can as well find your way into efficiency. But that efficiency is majorly trying to track how effective and how efficient are those assets being utilized. You have an asset of 10 billion naira, and on a yearly basis, you are just generating a revenue of 500,000, 1.2 million or whatever. You are not efficient as an organization. You are doing some things wrong. So it's basically categorized under profitability ratio. So I think we've talked about profitability and liquidity ratio. So can we talk about leverage ratios now, which is one of the very, very important ratios for us here. Leverage ratio. Anybody wants to know? You are the owner of that ratio. Let other people answer. Leverage ratio. What do we understand by leverage ratio? Anybody wants to help me? Anybody? Okay. But they are flying high.
The extent to which a company uses loan to finance its operations. The extent to which a company uses loan facilities to finance some of its operations.
Thank you very much. Examples of, okay, Mr. Ilya wants to say a thing.
Leverage ratio, to my understanding yesterday, is try to compare the debt you are owing and the liquidity of the company.
Yes.
That way, by the time you try to minus what the company is owing and the liquidity, then that now the level equity. Yeah.
Thank you very much. And remember, we used the biggest boy in Africa as an example. He said the $20 billion refinery that he has is not just exactly, the 20 billion is not his own money completely. Yes, he has his own money from it, but we said that other people's money are in. Leverage ratio is basically trying to see how much of other people's money do you have in your business. And we said that if you have too much of other people's money in your business, who is the owner of the business? Other people. So, and what we are saying in essence, is not like we are saying that you should not get a loan to finance business operations, but don't get a loan that will put you in a precarious situation. Don't get a loan that you will not be able to sleep at night. Aliko Dangote now, I'm pretty sure, except for the Pengasa and Nupeng issues, based on the kind of loan he got to finance that operations, he's sleeping well. So don't go and get loan that will choke you, and at the end of the day, you won't be able to pick calls, you'll be running helter-skelter, you don't want to go out daytime, you'll be setting your meeting for evening time and all that, because some people are looking for you. So, can we talk about the types of tests under leverage ratios now? We mentioned about 2, 3, about them. Huh? Yes, bank loan. No, we're talking about under profitability, we mentioned gross profit margin, net profit margin. Under liquidity, we talk about current ratio and asset test. So under leverage ratios now, what are the tests that we have? Oh, KC, thank you.
We have the debt to equity ratio.
Debt to equity ratio, what does that measure?
That's, I'll just go mathematically, that's total debt over shareholders' equity.
Thank you very much. Like what we've just said, we compare what we have as an organization to other people's money we are using to run our business. Yes, another type of ratio. Madam Funke, I'm coming to you now. So you just say everything. Now you can do over syllabus. Tell us as much.
We have interest coverage ratio.
Okay.
Which is our habits, earnings before interest and tax, divided by interest expense.
Okay.
Then he has said the debt to equity ratio.
Yes.
We also have equity ratio itself.
Thank you
We
very
have debt
much.
to capital too.
Debt to capital. Thank you. So leverage ratio is just trying to measure, okay, other people's money in our business, and at the same time, are you making enough profits to pay us back the money we are giving you? Are you making enough money to pay us back the interest on the money we are giving? That is a very key ratio. Madam Funke herself, if Mr. E submits a business proposal to our office now, those are the first things she will be looking at. She has to cover her own interest. If I'm giving you money, is your business able to generate enough money to cover the money for you to be able to pay us back? And not just paying us back. We are not angel investors. We are business, what's it called? We'll give you money, you pay us back with interest. Can you pay us back the money we are giving you? And can you pay us back the interest element? That is what the leverage ratio is basically talking about. There are a lot of ratios under that, but our major focus is debt to equity ratio, debt service coverage ratio. Debt service coverage ratio, you are saying, okay, the profit you are making in a particular period, can it cover your loan? And how many times? For example, my profit at the end of the year is 10 million. And based on our calculation, I'm supposed to pay Madam Funke's organization back on a yearly basis. I'm supposed to pay them back 4.5 million. If I'm making a profit of 10 million and the principal and interest I'm supposed to pay her back is 4.5 million, Can we do the maths? Am I okay enough to pay her back that money? Huh? Am I? Okay. My profit annually is 10 million, right? But Madam Funke, based on our repayment schedule, net profit, your net income now, at the end of the day, based on the repayment schedule that I have with our, I'm supposed to be paying back 4.5 million per annum. And for a particular year, I've made a profit of 10 million. And I'm supposed to pay her back 4.5 million. What is happening there? I can pay, right? How many times? 2 times. So if she sees that in her book, will she not be encouraged to want to give me loan? She will. Now, there's another one. We call it interest coverage. The interest I'm supposed to be paying on the loan she has given me is 1 million naira annually. And I've made profit of 10 million. How many times will I be able to cover the interest I'm supposed to pay her? 10 times. If she sees that in my book, will she not be interested in giving me the loan? Will she not be confident enough, okay, this guy can cover the money we are giving him and also pay us interest? Are we together? Now, the last one we talked about is what? Efficiency ratio. Just what does efficiency mean? What does efficiency mean? Huh? Yes, he mentioned it. Optimal utilization of resources, be it human capital, be it asset or whatever. It's just to ensure that you are optimally utilizing your assets. So you cannot tell them you want to spend 200 million in buying a processing plant. At the end of the day, you are using that processing plant to just generate 500,000 annually. What are you doing? Just close shop and go home. You are not efficient. So we are trying to measure that, okay, if you are putting in so much money in assets and all, how are you utilizing those assets? Is that we call it, is it undercapitalization now or overcapitalization? If you are investing so much and getting it. Underutilization, thank you very much. Are we together? So that was where we stopped yesterday, and we were talking about the formulas and all of that. So where we ended the class yesterday was on the formulas for ratio analysis, and we talked about the other financial metrics, NPV, IRR, and payback period. So we were supposed to have a class assignment, a class exercise yesterday. So let's start with that this morning to quickly brush up our brain. Can we see the screen better now? We apologized yesterday about the way the screen was. I know it was a bit terrible for us to read, but can we see it better today? We can. Okay, the question says, Golden Harvest Limited, a mid-sized food and beverage manufacturer in Kano, is considering the purchase of a new automated packaging machine to improve operational efficiency, reduce labor and energy costs. Now, we have items from our financial statements. Can we see this? Revenue, cost of goods sold, gross profit, operating profit, EBITDA, depreciation and amortization, interest expense, net profit. And we have other information. We got a loan of 300 million and our principal repayment is 50 million annually. Going by our formulas that we talked about yesterday and which you have talked about. So real quick, can somebody lead the class and help us do this calculation? Please, who will volunteer? Or do you want us to do it in our books and we ask, how do we want us to do it? We should do group. No, we still have a group assignment that we are doing. Oh. But okay, yes, let's quickly do the group. So group 1, group 2, group 3. Let's quickly do it real quick. Oh yeah, we have 10 minutes. Quickly, let's just put our heads together based on what we did yesterday. Sorry. Based on the formulas that we have. Can we quickly calculate all these things? Can we quickly do it as a group, quickly? Somebody has suggested. So we are going to have 2 group works. Group assignments. Okay. So that we will not be selfish. Madam Funke, please stand up. We are in an examination hall. You know, when we were in school, we do what we call formation. The way we sit down in that exam hall. So that place is congested. I have too many strikers here. Lewandowski, Lewandowski, see Ronaldo. Everybody is here. So let me. Eh? No, 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 no. Let me reshuffle. Let me reshuffle. I don't want too many strikers. This table is full of striker. I'm not leaving you like this. I do not agree. Eh? No, 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 no. Eh? Eh? There's no prize. So, they don't have on that table. There's none on that table. But anyways, sake of our time, let's just do this. But by the time we want to do our group work, I'm pretty sure I will mix everybody up. Don't worry. But shall we quickly make attempts? We have the formulas and we have the numbers. What is our gross profit margin? Our gross profit margin is profit over revenue minus over what? Where's your formula? Look at it quickly. So we have a formula for our gross profit margin. Gross profit margin is, I'm not going to give us the expo. We already talked about it already this morning. Gross profit. See? Gross profit. Same thing for EBITDA margin, net profit margin, debt service coverage ratio, and interest coverage ratio. So, let's just 10 minutes. 10 minutes. EBITDA is 592. Are we done? Ah, Mama T, I've been looking for you. I've been calling your phone. You did not pick. You are welcome, ma. We should be rounding up by now. Are we done? Cover. We still have our primary group work to do. This does not require extra sheet. It's just a very simple calculation. Let's not overdo. Once you get the formula, we have the numbers you are supposed to use. Gross profit margin. It is pretty straightforward. Your net EBITDA margin. It is pretty straightforward. Net profit margin. Your debt service coverage ratio. We have the formulas. So I'll give us 2 minutes. Then we look at it together so that we can move. Okay, so let's quickly do it like this. Can table one, can they give us somebody to come and tell us, or maybe I'll just come to you, then you represent your table and tell us your numbers, what you got. We have somebody from table 2 and table 3. Are we done? Almost. Table 3, what's going on? Nothing is going on. Why is it disjointed? Huh? Ah, something has to happen, oh. Make something happen. Well, we've talked about this thing. Table 1, are we ready? Table 2, are we done? Okay, table 2, Mr. Sonny, how far? Your group should be ready by now. You guys are good to go. So the challenge is with table 3. You guys are ready? Okay, so table 1, let's have somebody just present the numbers. Who wants to do us the justice? You want to do that? You can try. Everything is in million. Oh. You can just say 592. You don't have to put the triple zeros. Just use the numbers straight. We have not started our work for today. Oh. So table 1, please. Let's manage our time. All right, please. Can we pay attention, please? Table 1, go ahead.
Thank you very much. No, I will use yours. A non-financial representative presenting the financial. So this, so that you know our table is very versatile. The first question is 19.5%.
5.
19.05%.
How did you arrive at that?
We use the gross profit
Okay.
over the revenue.
Gross profit over revenue. Okay.
Multiplied by 100%.
Okay. Next one, sir.
The next one is EBITDA.
Yes.
Divided by the revenue.
Okay.
Multiplied by 100%.
What is your figure?
4.86%.
4.86. Then the next one.
The next one is the net profit.
Okay.
Divided by the revenue.
Okay.
Also multiplied by 100%.
Okay.
We get 2.96%.
Okay. Debt service coverage.
Then DSCR. We have the net, EBITDA divided by interest payment plus principal repayment. Then we have the amount as 6.29.
6.29.
The
trying to
formula
use the
used,
export
EBITDA divided by interest payment, then plus principal repayment. Look at the principal repayments, 50. So we have 6.29.
Okay.
Then the last one, the interest coverage ratio is EBIT this time around, not EBITDA. EBIT divided by interest is 404 divided by 44, and we get 9.18.
9.18. Thank you very much. Table 2. Who is presenting? Oh, okay. Oh, welcome, sir.
So for gross profit margin,
yes. Please let's pay attention. Let's pay attention, please.
We divided the gross profit by our revenue.
Okay.
And we got 18%. That is multiplied by 100.
You got what?
18.37.
Okay. Yeah. EBITDA margin.
For EBITDA margin, we took the value for EBITDA, yes. 592. And the reason because it's actually not a function of the revenue, considering the fact that it's before those other indicators.
All right.
Therefore, the net profit, it was not profit margin, it was our net profit divided by revenue. And we got 2.9%.
Okay.
100, yeah.
All right.
Then for debt service coverage ratio, we use our net profit over the principal repayment to get the value. And we got 8.81. Then for the interest coverage, we use our EBITDA divided by our interest expense, and we got 9.81.
Thank you very much. Table 3, quickly. Table 3, who is talking? Who is speaking? Back. Who? Okay. All right.
Good day. For gross profit, we use the formula which says gross profit over revenue times 100, and we came with the result of 19.05. Then EBITDA, we have the EBITDA margin, still the same thing, EBITDA over revenue times 100, which sum up to 4.87. Net profit, same way, that's net profit over revenue times 100, which gives us 2.96. So this is the most interesting part. I will need someone to teach me more about it. So when they say the debt service recovery, 360, that was the net profit over. So my issue was this financial information. So what we did, we just added it up together because the loan is 300 and the principal repayment. So I feel the total repayment should be 350.
Okay.
That's to me.
As a group or individual?
Okay, as a group, though within because of.
Okay.
I hope I'm one accord.
Yeah. Yes.
So I got 1.03.
Okay.
Then the interest coverage ratio, we use the
EBIT,
over
yes.
interest expense, which is 404 over 4, and it gives us 9.18. So some of these were approximated.
Thank you very much. Please, can we all give ourselves a round of applause? All right. So, because of our time, we'll just quickly brush through it. So, our solution is gross profit margin is gross profit over revenue. We got 19%. Is that all what we got? Good. EBITDA margin, EBITDA over revenue, which gave us 4.9. Are we together? Net profit margin, 360, that's net profit, which is 360 over revenue. 360 divided by 12,162 give us 3%. Debt service coverage ratio now is EBITDA divided by principal plus interest repayment. Right? So that is 50, our debt service coverage is 50 plus 44, which is our interest plus the principal amount, which gave us 6.3. Our interest coverage ratio is EBITDA divided by our interest expense, which gave us 13.5, which is at, sorry, EBIT. It should be EBIT, sorry, I'll take responsibility for that. So group 2, clap for yourself. Group 3, clap for yourself. So we move. Thank you very much. So now, Ma? Yes, ma. Yes, ma. Yes. 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 So, if you are saying that we are repaying the bank, Madam Funkena, we are repaying them. We are not paying them everything at once. There's what we call a repayment schedule, which is principal plus interest to arrive at what you pay for that particular month or for that particular year. So in this situation, what we are trying to do, this is just for a period. The total money we got from them is 300. We are not paying them that 300 immediately. So based on our repayment schedule, we are supposed to pay them 50, yes, 50,000 or 50 million for that year, and also the interest expense of 44. So what we are paying them is 50 plus this. So now that debt service coverage ratio is just trying to let, what it's trying to do is, do you generate enough to cover what you are to pay us at a particular time? Are we together? All right. So now to the order of the day. Financing instruments for RECP and IEE projects. So tools for financing projects. The first one I want to talk about here is grants. Grant, can anybody tell me what a grant is? Huh? Huh? It's free money. So, okay, let me hear our opinion. Let me go around quickly. Sorry.
Grant is not a free money. Grant is like helping somebody or investing is a form of investment also.
Okay.
So you are doing, yes, support, yes.
Okay.
Yeah.
Thank you. Anybody wants to further break it down?
In Yoruba, I would say grant is ifa.
Ifa.
But yeah, but
Ifa.
literally, the grant is money given either by government, organizations, foundation. But the difference is that it's for a specific purpose, not meant to be repaid.
So, because of time, it is free money. Let me explain. Let me just build on what they've said. Grant is money given to you. Grant is money given to you to do certain things. However, what they are after is to see the impact of the money they have given you to do certain things. Grants is given to you to measure and not for you to improve your business or what. They want to see the impact. Are we together? It is free money. They are not telling you, okay, come and pay this money back. We are giving you this money. However, you need to meet certain conditions. Use this money for this, for this, for this. If you do not use that money for that and they come to your organization, they might tell you, we want our money back. But if you follow their instruction and you do what they are requesting of you, no problem. And at the same time, grant is that if they give you 500,000, you are supposed to use it for a particular program, and you are looking at it, let me save costs, let me manage costs and all that. By the end of that grant period, they come to you and say, okay, we gave you 500 to buy 2 vehicles and 1 wheelbarrow. You are now saying, because we are very prudent, this, that, we only bought 3 wheelbarrows, but we didn't buy the cars. Ladies and gentlemen, they'll tell you, where's the balance? Are we together? That is grant. It is the cheapest way to finance projects. It is very cheap. It doesn't cost you anything. However, we are moving from cheap to the expensive. Now, we've talked about grants. Then there is bond, which is, what is bringing us all together. Then there is corporate debt. And then there is project finance. And then there is equity. It's always very difficult in some instances for us to dip hand into our pocket to do some projects on our own. Do we agree? So, we'll talk about bonds, then we'll talk about corporate debt and project finance. I want my organs to, because of our time, can any of my organs tell me the difference between a corporate debt and a project finance? Anybody? Corporate debt and project finance. I'm here, sir. Difference between corporate debt and project finance. Okay. Mama T is back.
Okay, thank you. So, for me, corporate debt are the debt or the borrowing by a corporate organization. It can be used for any activities of the organization when the need arises. It can be from the bank or from any of the any financial institution. But for a project finance, the money actually is being borrowed. It might be from the bank also or any financial institution, but it's for a particular project, depending on the type of project the organization is want to embark upon, such as financing an asset, maybe, or an equipment to be used for production, or it might be in terms of building a new building.
Thank you very much.
Thank you.
Please, can we give... She has finished my work on this slide. Corporate debt is money an organization applies for, you collect loan to run your business operations. But project finance, it is meant for a particular thing. It is meant for a particular thing. You cannot deviate. But for corporate, you can say, okay, we are collecting social bank. We'll use it to pay salary. Some of our guys are going for training. We will use it for training and whatever. So the primary focus of this training is debt finance, giving the project partnership with both DFIs and corporate lenders. So we've explained corporate debt, corporate loan, corporate debt, and project finance. Do we all understand? Do you understand the difference between corporate debt and project finance? We do. All right. So debt finance, which is debt financing, which is green bond. So I'll just give us examples of what has been going on, like I mentioned earlier, yesterday. Access to information. Okay, sir.
Does it grant the person that agreed that project finance, does it grant the person like a equity right, like a shareholder's right? I'm just thinking. Okay.
No, it doesn't give you that right. So if you are financing a project, your authority and whatever ends on that particular project does not extend to the organization at large. So debt financing, green bonds were created to fund projects that have positive environmental and climate benefits. The first green bond was issuance was announced in 2007 by European Investment Bank to raise funds for climate projects. Now, let's bring it down to Nigeria. In 2017, first FGN green bond was issued, that was 10.6 billion. In 2018, Nigerian green bond market development also came up with something. 2019, North South Power Limited issued a bond of 8.5. Access Bank also issued green bond in 2019. Federal government also issued another one, another 15 billion in 2021 and 2022, 1 watt solar. So these are examples of the green bonds that has been going on in the background that maybe some of us don't even know. But the reason why we are here is for us to have an understanding and key into it going forward and go to the right source to access some of these bonds, these loans. On the premise that you have your document appropriately put together. If you go to them with a shabby document, they will tell you to leave their office in a shabby manner. But if you prepare your document the way you are supposed to, properly curated, your numbers are okay, and doctored your books or whatever, they will give you your audience and they will provide necessary support even beyond the loan they are giving you. Are we together? So now, debt financing, there's what we call concessionary debt. What is a concessionary debt? This is a debt, this is the kind of loan that you get that is below the market rate. What I mean by that is, for concessionary debt, you are saying that, okay, maybe normally the commercial bank will give you loan at 27%. But for concessionary debt, you can get it at maybe 4.5%, 6%. I'm just saying. No. It's not from commercial banks. Commercial banks. So most times, these concessionary debts are financed by development financial institutions. Examples of development financial institutions. Huh? BOI. Yes. It's not just BOI. Eh? Bank of Agriculture. Yes. We still have more. African Development Bank. Yes. DBN. What is DBN? Huh? Development Bank of Nigeria. Thank you. So those are those that will give you concession and not commercial bank. Oh. If you go Access Bank now, I want concessionary. Nexim. Thank you very much. So why are we looking at this concessionary debt? It gives us lower debt service burden. The interest rate is always low, right? It also improves our project bankability because they provide support to us. Where can we find this in Nigeria? BOI IEF's facility. BOI, can you guys confirm that this is still in existence? IEF facility. What kind of, okay, maybe sir, can they maybe at some point speak maybe for like 5-10 minutes on what is available from their own end for benefit of others? Market rate. Yeah, is a customer to them. So there's a testimony. So it's not like we are boboing anybody. It's available. They will guide you. Yes, grant does not include interest. Grant? No, grant is without interest. Whatever they are giving you that has interest is a loan. It is a loan. Yes, sir. So there are free money. We'll talk about access to information. So let's move on. So The other type we want to talk about is what we call blended finance. So without much ado, not to waste our time, we have a project that is costing us $1 million. We want to buy a machine that is $1 million, right? However, profit-making organization says that, okay, because the kind of machine you are bringing in would impact the society by reducing carbon emission and whatever. Out of that $1 million, we will give you $500,000, right? At 0% interest. At 0% interest. 0% interest. Bear that in mind. Then two, a commercial bank. What? Yes. Then now we approach a commercial bank. They are willing to give us 500,000 at 12%. Remember, our project, the project we are trying to finance is $1 million, right? But we have a non-profit making organization that give us 500,000 at 0%. And we have a commercial bank that is willing to give us another 500,000 at 12%. What does that tell us? Hybrid. You are getting one at 0%, you are getting another one at 5%. So now, in total, that $1 million is at what interest rate? Huh? 6. Why 6, sir? The effective 6 interest. Reason why? Somebody is giving you 500,000 at no interest. Another person is giving you 500,000 at 12%. 500 plus 500, 1 million. 0 plus divided by 2 is what? Does that not make sense for your business? It makes sense, right? So that is what we call blended finance. But some organizations find it difficult because of access to information to, access the right channel for them to be able to get those that. You understand? Are we together? You have a question?
Thank you very much. I have a question. My question is on step 1, the non-profit contribution concession layer. When the $500,000 is given at 0% interest rate over the period of 10 years, does it mean that after the 10 years that it will now start counting? You have to start paying interest or something? Or you refund the money back? So why the 10 years inclusion? Okay.
So now the blended outcome is saying we've all agreed that it's giving us at 6%, and the interest we are going to be paying is lower, which makes sense for our business and for us to do what? To generate more money and increase our profitability level. So we have an example of a blended project in Nigeria that was done some time ago. Another type of hybrid financing is guarantees and risk sharing. This talks about credit enhancement provided to reduce risk for lenders. So somebody was saying yesterday that our risk appetite differs. Some, they would like to go for higher risk to yield higher returns. Some would like to manage their risk so as not to have unnecessary high blood pressure. But there are some people, if they never go high, they are not feeling accomplished. Some people like high risk ventures. Huh? So why it matters is it unlocks commercial bank lending. Commercial bank, their returns, their interest is always high. But some people, they will be like, it doesn't matter. I know the business I want to do. I will be able to pay them back. And accurately, if you look at their books, you see that, okay, one way or the other, they can be able to manage commercial banks, even though their profit margin would be affected a little bit. Are we together? So these guarantees and risk sharing also requires collateral requirements from borrowers. Now, there's one thing that I have noticed. Our commercial banks do not have this kind of guarantees. For example, when we were trying to get a loan of about $20 million from BOI some years back, 2017, 2018, okay, they said, okay, we'll give you this money, but we need a bank guarantee. What does a bank guarantee mean? Can anybody tell me? Do you know what a bank guarantee means?
Is a form of performance of a company or an organization. How they are
I would not agree with that. Sir,
I said a bank guarantee is a bank guarantee. In the event that the client cannot pay, the bank will bring the funds.
basically, a bank guarantee is just saying that we are not hold Mama T responsible. We will hold Oga Itan, right? We will hold Oga Itan responsible for the money Mama T is collecting from me. I will hold you responsible, not her. So what happens in this scenario is that these commercial banks will be like, instead of a guarantee, why not come and collect the money from us? Because if you collect from the commercial banks themselves, the interest rate is higher, they will make more money. But for me, I'm looking at single-digit rates, and you now tell me I should come to you. It's not, the commercial banks will tell you it's not good business for them. That how are they so sure, this, that. But eventually, some of them will still do it. But what they will require from you is the asset that you are trying to invest in. They will collect everything from you, all the certificate and whatever. Once you are done paying the money back, they will return it. But in the eventuality that you are unable to pay back, they will just go and sell those assets and recover their money. Are we together? So, ladies and gentlemen, I don't know if you have any questions, because we still have, I want us to go into a proper study very soon. So, please just give me a sec. Let me ask a question. Any question? Okay, there's a question before we go.
I didn't mean to take the class back, but I know that was covered yesterday. But the good thing that you did the review this morning, and I was like, for management executives, which of these financial ratios or maybe these financial statements should be presented monthly, quarterly, and most times we always pay attention to these books at the end of the year. But I feel that with what you are saying, certain things should be looked at before they go deteriorate. So which one do you think management should look at monthly, quarterly?
So, on a monthly basis, management should look at their income statement. How much did we generate this month? How much have we spent? Did we make profit this month or not? If we made so much profit this month, okay, we are encouraged to do better next month. If we do not make profit, we are making losses. What channels did we spend so much that we need to correct next month so that we will not make that loss against next month? Then also your balance sheet. Same as your cash flow. You need to be able to monitor your cash flow properly. How is money coming in? How is it going out? However, for your ratios now, your profitability ratio is very important, right? Profitability ratio is very important. Your efficiency ratio, to see how you are performing. Are we, as an organization, utilizing all what we have as assets? Are we utilizing them properly or not? If we are not, you need to discuss with the production manager what is going on in that factory, that the output we are getting is very low. And at the same time, you need to discuss with the commercial manager, why are we not making so much sales? This machine is producing so much for us, but we are not generating enough money. Do you understand? Then your liquidity ratio is important. That leverage ratio is only to play when you are operating with other people's money. Are we together? Thank you. Any other question? Any other question? In the absence of no other question, please, can we go for our tea break? We'll be back at 11:30, please, so that we can have our group exercise. Thank you. Fine. I'll collect my time back. I'll collect it back. Yes, I'm always collecting, yes. I'll collect it. So, ladies and gentlemen, please, let's settle down. And at this point, we are not sitting the way we sat. We are about to have a reshuffle. We have a case study that we need each and every one of us to participate. We are going to have 3 groups. I think 3 groups for us. So we need to split ourselves. All the top strikers that are on that seat, I need to move them. Even Mama T, I think I need to change her position. She's playing a role as supporting striker. I'll move her to another location, the top striker. So, please, can you help us tell those that are outside to please come in? We need to move. Please, help me tell them to. This is 48. We need to be done with this by 1. So I'll give us the privilege. Those of us on group 3, you can reshuffle yourself anyhow you want it. Now, let's do it before some other people come in. I'm just giving us expo, head start. I'm giving us an expo, real quick. Real quick. If you want to change, do it now. I scatter us. But you see, these my top strikers here. See Ronaldo, Messi, Lewandowski that are sitting together. It's not, my God, I go can't shock you. I go come out all of them for there. You go see. No, they are coming. Don't worry. I would. All right, who do we? Why this man no come today now? Mr. Valentine is not here at all today. Actually, Khadija, are you okay where you are? Okay, sir. Are we all fine here? Yes. Oh, problem don't do overnight. Papa no fit wake up. Hey, it is well. Mr. Ilya, are you fine where you are? Okay, sir. So let me go and pick them. Let me go and pick my guys and change their position. But please, I think we need to change our sitting position. Let's do it like a round table or straight like this. So it's a group work so that we can all communicate better. So please help me. Let's just turn it. Yeah, we need to turn the table. I think two tables.